Live on Sky News Business, this is Market Countdown.
Very good morning and welcome to Market Countdown. We're just on 8 a.m. over here in the east, just under 2 hours until the start of trade gets underway for the new week. The local market looks like it will kick off the week on solid footing as the S&P 500 hits a record high. Those SPY futures up about 16 points. And the local Aussie dollar are sitting there just under 80 US cents as the markets price in a greater chance of a rate hike stateside. Also making news this hour, the New South Wales Supreme Court is set to decide on Bruce Gordon's 10 network challenge later this afternoon, and reports of an over $4 billion price tag lobbed for ANZ's wealth unit. And before we get to the local session, let's just take a step back, checking on how those US markets closed there on Friday. Another record high there for the S&P 500. 2,500 it passed there, you can see, for the first time ever. The Dow Jones also closing at an all-time high there. Investors very much shrugging off those North Korean tensions and the latest missile launch that we saw there. Now, for the week, the Dow Jones actually rose about 2.2%. That was the biggest weekly gain this year. The S&P 500 gaining 1.6%. and the Nasdaq rising 1.4% for the week. But big focus on the S&P 500 closing at that record high there on Friday, hitting the 2,500 level for the first time. Technology stocks bounced back after 2 days of declines, and we saw those telecommunication shares also rising.
The Dow and S&P 500 closing at record highs Friday. The S&P rising above the 2,500 mark for the first time. Telecom services stocks helped lift the markets. Investors shrugged off North Korea's latest missile test and weak domestic economic data. Ken Kamen of Mercadian Asset Management.
The issue is people are getting kind of numb to the news. This hyperbolic coverage of storm, the worst in history, and the missiles and potential terrorist attacks everywhere. Everything seems so hyperbolic that I guess tuning out is becoming the rational thing to do, which is probably the not rational thing to really do for your portfolio.
Investors got weak data that included the impact of Hurricane Harvey. U.S. retail sales unexpectedly fell in August, and industrial production fell for the first time since January. Oracle shares dropped. The company issued a disappointing profit outlook that indicated a slowdown in growth of its soaring cloud business. Among the top S&P 500 gainers, Henry Schein. Piper Jaffray raised its rating on the dental equipment distributor to overweight from neutral. Equifax shares again lost ground. U.S. Senator Elizabeth Warren, a champion for consumers, said she has launched an investigation into the credit bureau's massive data breach. In Europe, financial and healthcare stocks drove the markets lower.
Not only was the tensions in North Korea, which certainly rattled markets in Asia and our market on Friday, but not only that, you had weaker U.S. data. Both retail sales and IP were below expectations. The market was happy to shrug that off and say that was the impacts of the hurricane, so we're not too worried about that. And also, too, they shrugged off the fact that there's been a hawkish shift in expectations for all developed markets, central banks after the Bank of England. One of the doves on the Bank of England was very hawkish, saying there's going to be more than one rate hike in the UK. So yields moved higher. Expectations of a Fed rate hike have moved, in December, have moved well past the 50% mark. And yet investors continue to buy stocks. And so it just shows you how resilient the market is. As you said, the S&P closed above 2,500, one of the best weeks of the year. Nothing to see here, nothing to worry about.
Well, for more on these moves, I'm joined by Nathan Bell, Head of Research at Peters McGregor Capital Management. Nathan, a very good morning to you. Pretty incredible how resilient these markets continue to be despite the sort of hawkish shift in central bank expectations and obviously the increasing geopolitical risks. Why do you think that is? Why do you think, markets have been so buoyant right now?
Yeah, I think the previous commentator put it perfectly. He said we don't really know how to price all of these huge events, and therefore no one's doing anything. And if we have a look at stock market returns over very long periods, over 10, 20 and 30 years, normally valuation is your best indicator of what your future returns look like. So the geopolitical stuff is very interesting news and something we all want to pay attention to. But in terms for investors, you just need to stay focused on valuations. And I think the point he was sort of trying to make was that valuations are probably something that people are thinking less about at the moment because they're sort of looking at everything else when they actually really should be focused on the valuations they're paying for stocks.
When looking at your investment process and when looking at how to, I suppose, deal with some of these, escalating tensions, how critical is it that you analyse management? Why is that such an important part of your investment process?
Yeah, absolutely critical for us, and I think that's something that's not as well appreciated as what it should be, is that every year management takes the existing profits from that year from the business, and it has to either reinvest them to grow the business and fend off competitors, or they have to pay dividends and make share buybacks. And I think that's such a crucial element of managing a business that can either destroy a business's value or create huge amounts of value. And there's no one that's more shown this than Warren Buffett over 50 years. His capital allocation has been absolutely tremendous. And I actually think if one thing you looked at, the company Equifax came up in the prior clip there. It's a business that's now potentially under investigation, and it turns out that there was some insider selling. I'm not sure how far back or how much the volume was, but I reckon if there was just one thing you looked at as an investor, if you looked at whether insiders were buying a lot of stock or selling a lot of stock, I reckon that'd be the #1 indicator you could just about look at and still make money.
With respect to IPOs and floats, you have a 3-year rule, I believe, to help avoid some of those dud IPOs and floats. Why is that?
Yeah, so the 3-year rule is about, if you take the example of private equity, which gets a pretty bad name for floats and IPOs, and I think it's deserved, is that they tend to do things to strip out the cash of the business before it lists. And that might be taking actual cash out and putting a lot of debt on the balance sheet, or it may be over the previous years not investing a lot in the business. So often it actually takes 2 or 3 years for these problems to show up after listing. So I think if you can use that 3-year rule and always make sure you work out what the incentives are when the stock lists, like who's selling the business and why they're selling it, I think that would very much keep you out of most of the trouble.
What about spin-offs? Where does that kind of fit? Do you think spin-offs potentially are a more reliable source of profits for investors?
Yeah, I do. Spin-offs are not something you see a great deal of in Australia, but yeah, much more common overseas. Spin-off is normally where a big company tends to sell off a smaller division into a separate company. And the historical returns for spin-offs are absolutely excellent, not just for the company that's been spun off, but often for the parent as well. And if you think about the smaller company that's been spun off, the typical behaviour is that the big investors want to sell the small thing and then just hang on to the large business that they already owned. And so you tend to get these huge gaps in the initial trading of the smaller company. But now that it's got its own management who doesn't have to fight with other people within the business for money to invest, and with a management who's incentivised by the performance of their own business for a change, it's amazing what the results can be over time.
Do you have a current example in your portfolio?
Yeah, a company called Liberty Lilac, L-I-L-A-K. It's John Malone's, or the part of John Malone's broadband and cable TV empire in Latin America. It's currently actually what's called a tracking stock, but it's not that important to go through. But what you need to know is it's going to be a full spin-off in December, and it's about 1/10 of the size of its parent company when it gets spun off. So again, it's been sold down very heavily because investors want to stick with the big company, with the parent company, Liberty Global, and that's left Liberty Latin America trading very cheaply in our view.
Nathan, what else are you doing right now? Obviously, we talk about positioning portfolios with geopolitical events, using safe haven assets and so forth. What is your view, say, on investing in gold, for example, whether it's via gold bullion, the direct commodity itself, whether using ETFs or going directly to the companies? What is your view on looking at gold as a hedge against these risks?
Yeah, I've been trying to get my head around gold for about 30 years and still haven't got there. The way I figure it is over time that companies just owning stocks tends to work out very well, and stocks are actually one of your best, if not best, protections against inflation as well. The thing about gold is I tend to believe that the best way to own it is in bullion. There are ETFs and other cheaper ways to own it, but if you're going to own gold for that basically once-off panic or epidemic or whatever it is, you really want to own that gold and know that you've got it, not just you've got some sort of ticket that maybe it's sitting in some vault somewhere.
Where else are you looking for value? I mean, we were talking about those elevated, valuations in the United States. Relative to elsewhere, are you looking at investing in other markets? How does the Aussie market kind of stack up relative to the rest of the globe?
Yeah, potentially I actually think the Australian market's very expensive. We probably won't see that until the banks have to deal with a much slower property market. But if I look at the healthcare sector, that's extremely expensive, and it's very expensive around the world. The two big themes probably running through our portfolio at the moment are, one is the European financials. I think it's the safest time to buy European banks in at least 15 years, and whereas this, I think, it's the riskiest time to buy Australian banks in about 27 years and counting. So that's one shift, and the other one is we own a few technology stocks in China and we have the currency hedged. So if there is a recession there, we feel like we're very protected because those particular businesses aren't very sensitive to the economic environment.
With respect to those technology stocks, I was reading a view just last week, actually, that although from a historical standpoint, yes, the broader market may look expensive, some of those tech stocks or those FANG stocks that we often talk about are looking relatively inexpensive. Would you agree with that comment?
Yeah, I certainly don't think this is a case of 1999 where we're valuing businesses on eyeballs. These are absolute cash gushers and they should be valued as such. And there's a lot of assets within these businesses that aren't actually hitting the profit and loss statements. So YouTube is one that's potentially worth over $100 billion for Google or Alphabet. But that's not even in the PE ratio. The reason we like the Chinese tech stocks in particular is Baidu, which is the Google of China, is only trading at about 13 or 14 times free cash flow, which is about half the valuation of Google, and yet it has a 90% market share there. And JD.com is like the Amazon of China, and it's just got an enormous growth runway there, even though it's not making a lot of profit today. All
right, fantastic. Nathan, we'll leave it there. We appreciate you joining us as always. Thank you so much.
Thanks very much, Leanne.
That was Nathan Bell joining us there from Peters McGregor. Well, let's switch focus now to the local market. We'll